Everyone, exciting to see everyone here. We have had about 150 sign-ups, as well as interest on for those who aren't able to attend, and Daily Maverick will be circulating this also. We're also live on Facebook, so really nice to see those of you who are on Facebook with us, and we look forward to all of your inputs. So welcome everyone. My name is Gillard Isaacs. I am the co-director at the IEJ, and this is the second in a series of webinars hosted Daily Maverick, and in this instance we are thrilled to be having a third partner, which is UNCTAD. As you all know, the theme of this week's webinar is a reflection on the implications of UNCTAD's flagship Trade and Development report and what that means in particular in the South African context. I was reflecting before this on explaining to the audience what our motivation was in doing this. And besides for this being a really powerful and well-researched report, as TDR is every year, I think it has particular sort of important messages for us. And I think it calls us to look both at the immediate, which we've been doing quite a lot of in South Africa, but also to lift our heads and try and look both at the international and at the medium term. And it's often it is difficult sometimes in these crisis periods to look beyond both the immediate and one's local situation. And South Africans in particular can sometimes be quite narrow in our focus on our local content. As you'll hear, the report notes that what we had before the crisis is not a status quo which we wish to re-establish, that in fact radical policy shifts are needed, and towards that it calls on us to imagine what a better world looks like, and it calls us to do this not only in our own context but also in the international context, and to understand what that means. And I think in looking at this international and local context and the intersection thereof, we see that our problems aren't unique, and we also see that we have the ability to learn from both the successes and failures which we've had here and which occur elsewhere. And of course, this conversation is taking place in the midst of an acute and deepening crisis in which policy responses, as seen last week, are certainly a continuation of the forms of policy interventions which we've seen previously. But I'll leave it to our panelists to expand on all of these interesting matters. Just on a housekeeping, I'm going to encourage that everyone takes a moment now in Zoom's chat feature and introduces themselves. It's always great to see that there is a wide range of people interested in this. So if you could just make sure you writing to everyone. Hi, I'm Gillard. I'm the co-director of the IEJ, okay? And so we can try create some interaction. You can interact both there and in the Q&A feature. I'll be searching those to see what issues are raised and therefore what questions we can pose to our panelists. The final housekeeping is that Mark Haywood, the editor of Daily Maverick Citizen, would normally be here to offer his welcomes also. Unfortunately, at the last minute, he was unable to, but we are appreciative of that ongoing partnership. Okay, I'm now going to introduce all four of our speakers and hand over to them. Just very briefly. First up is Richard Kozul-Wright, who is the director of the Globalisation and Development Strategies Division in UNCTAD and the lead author of the report. Richard has decades of experience both in economic analysis and in applying that in a policy realm, with a wealth of knowledge on both the international context and on the country-specific level. There are other UNCTAD colleagues joining us. Diana Vivian Barenclough is here. I see also in the list of attendees is Jeroen Capaldo, and I imagine that there are others there also. Fiona Tregenna will be our first respondent. Fiona has a NRF chair at UJ in industrial development, is a member of the President's Economic Advisory Council and a long-standing economist and economic analyst in South Africa. Seeraj Mohamed is the acting head of the Parliamentary Budget Office, which, for those who aren't aware, advises Parliament on budgetary issues. He was previously at Wits University and has a PhD which focuses on macro policy issues and financialization, which he'll speak to this afternoon. Finally, Sonia Phalatse, who is a researcher at the IEJ. Sonia is both a economist, researcher, and an activist. Her work focuses on two areas: feminist economics and what she'll speak to today, which is the role of infrastructure and private finance therein in economic recoveries. So it's really fantastic to have this wide range of expertise. And Richard, I'm handing over to you.
Thank you very much, Gilad, for that introduction, and thanks to the Institute for Economic Justice and the Daily Maverick for the opportunity to present this work on in this year's TDR. Let me try and, can everybody see that? I guess that's fine, right? I hope.
Absolutely, thanks.
I mean, this is, as Gilad said, this is our annual flagship publication. You can get it on the UNCTAD website. It's important to recognize that it is part of a series, really. We've been working around these themes that I want to talk about for the last 4 or 5 years, arguably well before that, but with a greater intensity in the last 4 reports. So for those that are interested, all those reports are available on the website. And as Gilad said, there are colleagues also online that in many respects have more expertise than I do in some of the detail of the discussion. We've tried to tailor a little bit the presentation from the report to address some of the specifics of the South African context, but I guess I hope the commentators will pick up on what I have to say and fill in the details and discuss some of the arguments with a degree of clarity that I can't really bring to the table. I don't want to go into a lot of detail about the nature of the crisis. We know this was a global public health crisis, which required a very drastic economic response, particularly in the advanced economies, of lockdown to try and deal with that health crisis, which has had major ramifications. It's not just a classic business cycle we're talking about here. This is a shock that simultaneously hit the supply and demand sides of the economy and also added a significant degree of financial stress across the global economy. We've made an estimate, and like everybody else, it is an estimate that the global economy will contract by some 4.3% this year. That's probably an underestimation given what's happened in Europe over the course of the last few weeks, and the return to partial lockdown, which is going to have obvious ramifications for economic activity in Europe and beyond. But even so, a 4.3% contraction in the global economy is unprecedented since the Great Depression and amounts to a $6 trillion wipeout of income from the global. So this is a huge hit, as we all know, to the global economy. We also know that the lockdown and the lockdown itself, the resort to lockdown and the response in terms of relief measures has exposed a huge difference between advanced and developing countries, and you can see that in the lower graph of this slide, which distinguishes the response in terms of fiscal loan guarantees. It's not on the slide, unfortunately. The light green figure is quantitative easing responses. So I mean, you can see a huge difference in terms of the capacity of developed and developing countries on average to be able to respond to the kind of shock that has been triggered by the COVID-19 crisis. We also know, of course, that the impact has played out very differently in developing countries as opposed to advanced economies. And indeed, in many developing countries, the economic consequences of the crisis were felt before many of them were hit by the health impact of COVID-19. And very early on, from early March onwards, there was a very vicious cycle that hit developing countries, triggered by strong capital flight to safety, as international investors became increasingly nervous about the consequences of the crisis. And that rippled throughout the economies through currency declines in many developing countries, a sharp fall in export earnings, goods, commodities, tourist revenues, etc. Another sharp drop in remittances, and a very vicious cycle that kind of locked in to many developing countries, whether they employed lockdown or not. South Africa was a country that did employ lockdown. Many developing countries were not even in the position to do that, but even so, were hit very hard by this change of sentiment in international capital markets. And everyone's been hit. We know that. The only region that we expect to see some positive growth this year will be East Asia, largely because of the way in which China itself has handled the crisis and is now back in relatively strong positive growth with positive impacts on countries of the region like South Korea and elsewhere. Very important though, I mean, we are fully aware that we're looking at a highly uncertain pattern as a consequence of this shock. The rebound began sometime probably in the last quarter, in the third quarter of this year, and we anticipated a recovery in the order of 4.1% in the global economy next year. But it's very important that we made a number of assumptions about that recovery strategy that I think are open to question. We assumed there would be no repeat lockdowns. We assumed policy continuity in terms of the size of the packages that have been implemented, particularly in advanced economies, and we assume that there will be no financial shocks of a significant nature as a consequence of the pandemic. All those are, I think, open to question, and so any projections that we make obviously have a degree of uncertainty surrounding them. I think importantly, just to say that although a lot of people have talked about a V-shaped recovery, and to some extent our own projection looks like that, it's not really a V-shaped recovery in the sense that it doesn't get us back to where we should have been in 2021, which would have required a global growth rate next year in the order of 10%, and that's certainly clearly not going to happen. So it's very much a technical bounce back with a lot of uncertainty surrounding it. What we do make a point of in the report, of course, is to emphasize the inequalities that have occurred as a consequence of the crisis, and that's an issue I want to come back to in a second. But the $845 billion figure there is the size of the increase of the portfolios of American billionaires since the crisis hit in March, which is a quite staggering figure, I think. But I think behind that, we know there are major differences in terms of the impact of the crisis between those people with or without capital, where capital is broadly defined not only to refer to assets, but also to skills and other features. So we are very aware that the impact is not simply an impact across countries, but very much within countries too. Again, just to bring in the South African story, this is our estimate of the size of the package of the kind of response we've seen country by country. I think it's important to point out that although there's a lot of talk about the size of the South African response, by international standards, it's certainly no exception. It's much smaller than we've seen in the advanced economies. It's much smaller than a number of economies in East and Southeast Asia. So it's not we haven't seen an exceptional response from South Africa, although the fiscal side of the response, as you can see in this figure, is somewhat larger than the financial response in terms of loans and loan guarantees, and I'll come back to that later. I think the second point that we wanted to make really in this report was the world economy was in bad shape before the COVID-19 pandemic struck. The global economy had not recovered effectively from the global financial crisis of 2008, 2009. There was a lot of talk, much as there is now, about recovering better and building back better, and the need for international coordination not to repeat the mistakes of the past. But to begin with, Gordon Brown's and Sarkozy's of this world certainly made an effort to implement a fairly ambitious and bold package that was agreed to in London in 2009. But essentially that package fizzled out from 2010 onwards, and the recovery was slow it was long, but very slow by historical standards and extremely uneven. And in a sense, we would argue it was a failed recovery. And there's a debate about why it failed, and there's a whole series of explanations for that, of which the most important, that again we'll come back to, is the turn to austerity that began really in 2010 in most of the advanced economies and many emerging economies somewhat later. But there was an unbalanced fiscal and monetary policy were not working in the same direction. Monetary policy remained very loose as fiscal policy tightened. There was an overemphasis on a belief that you could export your way out of the crisis, which ultimately meant more flexible labor markets, wage repression, and low aggregate demand in the global economy. Some were able to benefit, most weren't. A very heavy reliance on debt and trickle down from kind of growth in financial markets, inadequate financial reform. I mean, there's a whole set of reasons that I think we're now pretty familiar with. But if you look at the figures in the table here, you can see that the growth rates across the world in the period 2009 to 2018 were significantly below those in the decade before the crisis, and in most cases below, and in some cases significantly below, the decade of the 1990s. And in 2019, the growth rate across most parts of the global economy were actually below the average for the decade from 2009 to 2018. So there was already clear signs of a significant slowdown in the global economy as COVID-19 hit. And there's a question hanging over a lot of what we say about whether lessons have really been learned in the policy community in both developed and developing countries about the failure of the recovery from the global financial crisis. This is just a figure on the South African context, where it's been fairly clear that domestic demand has been the driver of growth in the period since the global financial crisis, and it's been getting weaker. It's been very heavily dependent on government spending. Government spending has been constrained for all kinds of reasons due to the rise of debt payments, growing inequality, and other factors. But importantly, external demand has not been a very strong driver of economic growth in the South African context. And clearly there's a clear imbalance, I think, that we see in the South African experience that will need to be addressed if we are to recover better from the COVID-19 crisis. And I guess I'll come back to that in greater detail later. The third point that we want to make, we tried to make in the TDR this year, is just it's linked to what I just said, the underlying conditions that have been left unaddressed in large parts of the global economy that have been a major source of tensions and anxieties in both developed and developing countries. And I think they're very familiar, I think, and the work that we've done in UNCTAD has tried to examine these over a decade or more. But the dependence of growth on debt, and not just public debt, but in particular, and you can see this in the figure on this slide, this is a world in which private debt in both advanced and developing countries, these are figures for developing countries, has mushroomed beginning in the early 2000s, but accelerating after the 2009 crisis. I mean, we are now in a very debt-dependent world, and that produces its own significant challenges. Hyper inequality, I don't think I need to talk to a South African audience in great detail about that. But this is an issue that UNCTAD has struggled with now since the late 1990s, when we were warning about hyper-globalization leading to hyper inequality and the pressures that come from financialization, wage stagnation, the emergence of dual economies, again in both the North and the South, and a failed set of policies. Environmental degradation, clearly, again, the problem not just of rising global temperatures and climate change, but environmental degradation more generally has become a looming problem, I think, and that everybody is aware of. And finally, an issue that doesn't get enough attention, again, I'll come back to it in the South African context, despite all the talk about hyper inequality being good for business, etc., this has been a world of insufficient productive investment, again, both in the private and the public sector. So these underlying conditions, I think, have all been exposed once again by the impact of COVID-19. And I'm not sure we really know how to respond to this. This is a cartoon from The Economist magazine, which kind of, I think, somehow captures our insecurities as these tsunamis of the COVID shock and global recession, climate change, etc., are spilling across the world. We have people saying, remember to wash your hands, which, you know, probably someone from the G20 or from the International Monetary Fund kind of giving you that advice as these looming dangers begin to hit particularly developing countries. So what we tried to do in the report is to contrast the possible ways out of this crisis. And we've in particular contrasted what we think would be a kind of business as usual approach if the lessons of 2009 are not learned, a return to fiscal contraction, an emphasis on free trade and competitiveness, and some, to the extent possible, loosening of monetary policy. And we have a model in UNCTAD, we have a global policy model that allows us to model some of these types of policy responses. It's a very standard Cambridge-based Keynesian model, but it's a fully consistent global model of the global economy. On our modeling exercise, what I call the baseline in this table, that kind of combination of policies, if it is repeated over the course of the next decade, will lead to weak growth, sluggish private investment, higher levels of debt, high unemployment, low wage share. And I think the interesting one there, of course, is the fact that the government debt to GDP ratio would actually increase significantly, despite all the talk that we have to have austerity to get budgets under control. The consequences of this package are not only bad for working people, but they're actually pretty bad for government finances too. So that's and in that we call this we see in this scenario, if it is generalized, a kind of lost decade for the world economy, and certainly an end to the idea that we can meet the Sustainable Development Goals by 2030. Behind this argument, of course, is a strong insistence that the private sector can't lead economies out of this kind of recession or build back better by itself. It's going to take government action before the private sector becomes confident about investing and consuming again. And the world economy can't export itself out of the crisis. Again, a lesson from the 2008-2009 crisis. Some countries can benefit from exporting, but their exporting comes at the expense of demand in other countries. And in the face of that kind of scenario, we offer an alternative, which focuses what we think is a genuinely expansionary alternative route out of the crisis, which focuses on jobs and boosting jobs and wages, a commitment to full employment or tackling informality in the developing countries, reconnecting wages to productivity growth, which requires more than simply expansionary fiscal and monetary policy, but does require active labor market policies, probably use of income policies and other tools to ensure that, because wages have, in most cases, have fallen significantly behind productivity growth now over decades, not only over the last decade, but decades before that. And that's a major source not only of insufficient demand in the economy, but also the growing inequality that we referred to earlier as underlying conditions. So that needs to be the focus of any kind of alternative strategy, complemented with strong and sustained public spending. And there are different demands on public spending depending on the context that countries find themselves, but decarbonization, the need to build up a social infrastructure and public transport in many developing countries, but also many advanced economies, universal public services, the strengthening of the care economy, all these issues that have been neglected largely under the mandates of neoliberal economic policy thinking need now to be tackled seriously as part of an expansionary program. Progressive tax measures, I think, necessary both for budgetary reasons, but also as a source of tackling inequality. And by progressive tax measures, we don't just mean income tax, but there's a whole discussion that we've been having in UNCTAD about the need to control corporate rent-seeking behavior, which I'll come back to in the South African context later. And of course, for many developing countries, the ongoing challenges of development, of which diversification and the need to get out of dependence on a small group of commodities or low-wage manufacturing exports is a persistent policy issue that we've talked about in UNCTAD. That brings in the need for industrial policy, the role of development banks, technology transfer, etc. Radical, which is always when we present this, radical, maybe radical, but this is exactly the kind of message that has come from the Financial Times, which in one way or another is the newspaper of international big business, which seems to believe that it is precisely these kinds of measures that are now needed if we're going to recover better and in a sustained and resilient way. So that the policies that we've tried to articulate and model are precisely the kind of policies I think that the FT seems to want to bring about. And and in terms of the modeling exercise itself, we find that this kind of policy package at the global level brings about faster economic growth, a more balanced fiscal position, budgetary position for governments, and a higher share of labor income in the overall distribution of income, along with a stronger domestic investment drive, which I think is very important to our story. It's not just a public investment story, it's very much in private investment being crowded in. And we find that across regions of the world. These are the results that we have comparing our growth revival story with the baseline austerity story for Africa and for South Africa. And the results are similar. I mean, you get variations across regions, obviously, but you know, the kind of commitment to a strong, publicly driven expansionary strategy, higher government spending, improvement in wages, delivers not what one would expect, which is a higher share of labor income in overall income, but it also delivers faster economic growth and a better public debt ratio by the end of the decade than is the case with the baseline scenario. So we do believe that this is a genuine alternative to the kind of austerity plus reglobalization strategy, which we fear will be coming back under political pressure as we come out of the COVID-19 crisis. Now, we are fully aware that for many developing countries, this puts pressure on their fiscal space. Public debt to GDP ratios will necessarily increase substantially at the beginnings of this. They're increasing now in response to the crisis, and they will increase further as this kind of strategy is adopted. And for that reason, we fear, you know, premature fiscal consolidation, as we saw in 2010, would kill the recovery prematurely and would be a source of, again, further weakness in economies. And so we do worry, of course, in UNCTAD about this question of whether developing countries in particular have sufficient policy space to be able to pursue this kind of strategy. We are fully aware that for those countries with some degree of monetary sovereignty, these are strategies that are much easier to pursue. When Jay Powell of the Federal Reserve says, look, I'm just going to keep interest rates at 0% for the next 3 years, that is not a kind of luxury that most developing countries facing tight balance of payments constraints, volatile exchange rates can easily pursue. And so this is a particular context for the kind of policies, for the kind of countries that UNCTAD deals with, which we are fully aware of and need to address quickly. And I'll come to that in a second. I mean, I think this is the situation, obviously, that South Africa faces. We've seen a rise of public debt in South Africa since the global financial crisis. Not exceptional. I think, as Gilad said, a lot of people seem to think that South Africa is exceptional. It's not particularly exceptional. It's the kind of trajectory that we've seen across other emerging markets since 2008, 2009. So there's nothing particularly unusual about that ratio. Of course, it puts pressure on the finances of countries in terms of meeting the pressures of financing, servicing this external debt, now at 48% of GDP. Both again, not just again, make the emphasis, not just public debt. This is a combination of public and private debt, short-term and long-term debt, private debt and short-term debt have been increasing significantly since 2008, as you can see in this figure. And some of that was necessary, given that public debt was a source of growth in the South African economy in response to the shock of 2009. Again, this was a necessary consequence to maintaining some degree of growth in the economy, and that's true across emerging economies. Again, it's not something that's unique to South Africa, but it does put pressure on debt servicing. Share of debt services as a share of export revenues have been rising. Servicing as a share of government revenues, of course, particularly in recent years, since 2014, 2015, has been rising. So, I mean, I think we're fully aware of that. The pressure on reserves, South African reserves, in terms of compared to short-term debt, are down to 140%, which puts pressure on financial markets and South Africa's access to financial markets. So, I mean, we're aware of that. The question is, do you address that by hitting the numerator, government spending, or dealing with the denominator, overall level of income and growth? And I think we have a real serious problem with the austerity option, which anticipates a reduction in the numerator as it damages the denominator by cutting back on growth, and therefore reducing government access to tax revenues, etc. So that's the context in which we're aware of the limit or the challenges that developing countries face in response to the shock and the need to find an expansionary response to it. There's a frustration now in developing countries. The finance minister of Ghana, I think, expresses that extremely well in the quote that I put on this slide, that somehow developed countries suddenly discovered that they had loads of money to throw at this problem, while African countries are judged by an older set of rules. And he uses a very emotive phrase, obviously, in that context, "I can't breathe." But I think it captures the real sense of frustration of many developing countries, that there are one set of rules for some countries and another set of rules for developing countries. And for us, the way to handle this problem is to find multilateral solutions first and foremost. And there are ways to do this that need to be exploited to support developing countries in their efforts to grow out of the COVID shock in a sustained and resilient fashion. And the report goes through a number of these policies: the need to use special drawing rights to give countries access to liquidity to respond effectively, the need to change international tax policies to counter the loss of revenues through illicit financial flows, and other practices of multinationals. Again, these are issues that are being discussed in the OECD and elsewhere. The use of capital controls needs to be a legitimate part of any policy toolkit. The IMF needs to become much more vocal in supporting the use of capital controls, in our opinion, rather than seeing them as a pariah option, which, even though they're still allowed within the IMF rules, tends to be the case. The need for a moratorium on related trade and investment measures linked to COVID-19, that's something we've discussed with the South African mission in Geneva, and we think that's, again, it's something that can be implemented very quickly if the political will is there. And better coordination within G20 countries, but just as importantly, between G20 countries and other countries. So that's I think we think those are options that are readily available to the multilateral system and need to be exploited. They haven't been sufficiently yet. The efforts of the G20 have not been sufficient. The efforts of the IMF have not been sufficient. In some respects, they're paltry compared with the size of the financial shock that has hit developing countries. Of course, at the same time, there needs to be some way of improving the, if you, for want of a better word, the real side of the economy. And that's something that UNCTAD has long insisted on. And this is a particular issue, I think, for South Africa, and perhaps the colleagues on the panel can pick up on. And the problem of heavy degree of export concentration in certain sectors is not something that is unique to South Africa. It's a problem across the developing world. Linked to that, there's a problem that we in UNCTAD have talked about a lot, and people like Fiona have discussed as well. The problem of premature deindustrialization, the declining share of manufacturing in total value added, or if you look at it from a slightly different angle in terms of overall employment, the sharp drop in domestic value added in manufacturing exports. All these are big signs of a weakness in particularly the manufacturing sector, and the failure of developing countries, in this case South Africa, to diversify, to provide a more robust base for integrating into the global economy. And I hope you can see that in the figures that in the table that I've provided here, because underneath that is the weakness in productivity growth that I think has become a feature of many middle-income developing countries, including South Africa. And this table compares what's happened to labor share and productivity over the course of the last 3 decades in South Africa, China, and Turkey. And as you can see, labor share, the adjustment of neoliberalism is to squeeze labor, and that's been an option that has clearly taken place in South Africa, China, and Turkey. I think what is interesting, and China's an exception, of course, and I'm not sure I want to go into that here. But what seems to be different is the ability of both China dramatically and Turkey more interestingly perhaps to raise productivity as they've squeezed down the share of labor. And these figures are simply the figures over the 10-year period. They're not annual figures, they're the period for the change over the 10-year period in the three columns indicated. But the clear difference in the ability of some countries to adjust by raising productivity rather than adjusting more dependently on squeezing down labor costs. And we attribute that in the work that we've done in UNCTAD to the breakdown of what we call the profit investment nexus, particularly in manufacturing countries. I mean, if the labor share is declining in the way it has in all these countries, that means the profit share is increasing. And the justification for an increasing profit share is, of course, that those profits are reinvested in plant and equipment and skills that will lead to ongoing further sustained economic growth. And that's clearly not happening across the board in the developing world. It's happening in China on a dramatic scale. It's to some extent happening in Turkey. It's not happening in South Africa. And the question then is, why is it not happening in South Africa? And that takes us back, I think, to work that we've been doing in UNCTAD about the emergence of the changing nature of corporate strategy, much more short-termist rent-seeking strategies that have emerged under highly financialized economies, but weak links between long-term financing institutions and productive investment, the weakness of development banks in the case, I think, of South Africa, less so in the case of Turkey, and certainly the opposite in the Chinese case, and also the inconsistency between macro and industrial policy, which again has been an issue that we've discussed a lot in UNCTAD, and I think is an issue in the President's Economic Advisory Committee that our council that Gilad talked about, I think I mentioned at the beginning. That's an interesting question, whether people think there is an inconsistency there, because if there is an inconsistency, it's a major weakness for building a kind of virtuous economic circle that can adjust to the COVID shock through economic growth rather than economic contraction. A very important issue that we've talked about, and I think it speaks particularly to the South African context, on this issue is the dangers of having a highly financialized economy. And this is perhaps an interesting contrast between Turkey and South Africa, which doesn't get us into the comparison with China that very many people feel a bit awkward about discussing. And you can see in this chart on the right-hand side, the comparison between Turkey and South Africa in terms of the dominance of the financial sector and the financialization of the economy in the two cases. And there are various measures that we put onto these slides: total banking assets as a share of GDP, external assets as a share of GDP. It's a little bit misleading because they looked pretty similar to begin with until you actually look at the scale on the left-hand side of these charts, where the South African scale goes from 0 to 300, the Turkey, it goes from 0 to 100. We didn't, unfortunately, have time to readjust them for one graph. But the difference in terms of the financialization of these economies is quite dramatic. And I think that is at least one reason why you see the very strong divergence in terms of private investment performance in these two economies over the course of the last 2 decades, with relatively strong investment in the Turkish case, not on a Chinese scale, but relatively strong, and relatively weak and increasingly weak private investment in South Africa in the period since the global financial crisis. And finally, just to go back to the big picture that Gilad talked about at the beginning, we do think that there are short-term options that the international financial and monetary institutions can adopt to help developing countries get through this COVID-19 crisis. But we do feel very strongly that the current structure of the multilateral system is not fit for purpose for delivering economic support on the scale and in the direction that most developing countries need for sustained and inclusive economic growth. And that's a big story that is developed in the chapter this year, and I don't really want to go through it, but we do propose a whole series of institutional reforms, some of them I put onto this slide, that we think are necessary to rebalance the international financial system in a way that can genuinely support developing countries to grow in a more sustained and inclusive fashion. And that's true in the trading system. It's true in the international financial system. We talk about a global Marshall Plan, but it's also true in the need to control footloose capital and what we call this penchant for corporate rent-seeking behavior that we think has become a very destructive feature of the global economic system and needs to be tackled urgently if we're going to recover better. So I'm going to leave it there. Thank you, Gilad, for the opportunity.
Awesome. Thanks so much, Richard. That was both wide-ranging, in-depth, and extremely clear and precise. I'm going to hand over to Fiona, Seeraj, and Sonia. I am noting questions, and I'm going to ask each of you to be as tight as you can so that we can have one last round for inputs. Fiona.
Okay, thanks, Gilad. Just trying to share quickly. Is that visible?
It is, yes.
Right. No, thanks, and Gilad, and to Richard for the really illuminating presentation. I'm glad to be part of such a super panel this afternoon, to which I must just mention that I'm contributing purely in my capacity as an academic. And it's really great to be debating the latest Trade and Development Report. The TDR has always been such a rich resource, with every one of them always presenting rigorous evidence and fresh progressive thinking on really topical issues. And just looking back at the TDRs for the last couple of years on issues such as financing a global Green Deal, changing the global financial architecture, structural transformation, debunking the delusion of free trade, and so on. Each of these is a really a valuable resource, which I would urge people to go back to. So turning a bit to to this recent TDR, obviously there's a wealth of material in there, but I just wanted to pick up first on, I think, some of the points from there that really stand out and kind of resonate for me in a South African context, particularly at present. And one of them, which is in the report and Richard has also spoken to, is really warning against the dangers of austerity strangling recovery from the COVID crisis. And I would include within that what's been referred to as austerity light. So any form of austerity, or perhaps we could say any form of inadequate stimulus, even if it's not austerity, will just plunge us deeper into the crisis, and not only deepen it and prolong it, but contribute to a long-lasting structural drop. So we really, I think in South Africa and more broadly, need a stimulus that goes far beyond sort of moving around some resources and a bit of niche stuff and cuts in other places. It really needs to be a massive stimulus to put the country onto a different growth path. And I think linked to that is there's a whole section of the TDR devoted to fiscal policy, and to sort of outlining a vision of a progressive fiscal policy and growth as a path out of high debt that many developing countries find themselves in. I guess what Richard referred to as kind of working on the denominator rather than the numerator. Obviously, it depends on the nature of the growth. It depends on what funds are spent on, whether it's productive expenditure and so on. But it's a broad alternative vision to what is typically presented. The TDR also has a section on inequality, and I think for me, well, obviously inequality is a huge issue for South Africa, but the kind of structural analysis of inequality there, I think, is really useful, linking it to so structural features and to policy choices, to things such as austerity, to hyper-globalization, with aspects of that including financialization, rising concentration of corporate power, and so on. So I think it's a really rich analysis of inequality, and it links closely with the emphasis in the report on employment and wages, and approaching this from a perspective of linking it with structural transformation, which is a very different approach from the kind of advocacy of mass jobs at low wages, which we are often presented with. There's a clarion call in the TDR towards avoiding another lost decade, as it's termed. And looking at the analysis of the South African case in the TDR, I think just one of the indicators of the previous lost decade is the data which is there showing that in South Africa over the past decade there was actually slight negative real wage growth. That's in addition to what Richard put up of the falling labor share and the very weak productivity growth. And obviously the concept of a lost decade is much broader than this, but it does speak to the failure of growth and development. I think for us in South Africa, the notion of avoiding another lost decade also brings to mind a sort of broader historical, political economy, policy issues, and so on. People have referred to what's been called 9 wasted years under Zuma. Obviously, it's a broad characterization, masking a lot of complexity and nuance. And I think industrial policy is a case in point where these were not actually wasted years, but perhaps for the first time under this period there was, I would say, a real serious industrial policy. But I think the moniker of 9 wasted years refers to the fact that even the gains in certain areas were undermined by the political economy of state capture, and so on. But what I want to raise is that it's easy to talk about the 9 wasted years, but in different ways, we can also think about the wasted years and the lost time before this under different administrations, foregone opportunities for making more of a difference. So lost time for really dealing in a meaningful way with the triple challenges of inequality, poverty, and unemployment. The lost time for laying the foundations for a growth path which has rapid growth, which is also resilient, inclusive, and sustainable. Lost opportunities for really laying a proper basis for industrialization and structural transformation. And we could think of other aspects as well in terms of infrastructure and so on. Now, of course, I mean, we also need to recognize the gains which have been made in different areas, improvement of people's lives in different ways and so on. But I think what I'm trying to draw attention to here is to say, even with those gains, it's not just a lost decade. It's beyond that, and we could have been a lot further along the road of structural transformation and having moved towards a more equitable society if we had made different policy choices. So this I think brings me to the current context and the COVID-19 crisis, and that this has really both highlighted and deepened existing fault lines in our society and economy. People have referred to the crisis before the crisis. I guess we could think about it as the crises before the crisis: poverty, inequality, unemployment, climate change, and so on. So I think the challenge for us in South Africa and in the world is what needs to be done and changed and done differently now to avoid us in 2030 looking back at the 2020s as another lost decade. I just want to turn a bit more specifically to kind of industrialization and industrial policy issues a bit. Just pulling out 2 charts here, just actually from a paper that I've been working on for UNCTAD. So this first one is just showing, sorry, I've just got some, I'm just trying to, okay. The people's pictures were hiding part of the chart for me. So this is just showing the monthly index of industrial production for different regions of the world, going up to the middle of this year. So we can see, for example, in the case of East Asia and Pacific, this line obviously being driven by China, a much shallower drop, well, earlier obviously, shallower, and a bouncing back to levels higher than pre-crisis levels. This solid black line over here is the world. This long dashed line is for sub-Saharan Africa, but since it doesn't include all countries within this aggregate, it's actually heavily weighted towards South Africa. And yeah, we are yet to see the data coming out for the most recent months, which will show us whether this is kind of bouncing back, similar as South Asia, which also had a very deep dip, or what the trend will be. But this does show the intensity of the drop in industrial production, which is going down to almost half of pre-COVID levels. Second and last chart. This is just comparing manufacturing by subsector in the second quarter of last year and at the same point in time, second quarter of this year. For South Africa, I know China's always a bit of an unfair comparison, but I do remember myself in some webinars, I guess in maybe February or early March, being asked to talk about kind of challenges and opportunities for manufacturing in COVID, talking about opportunities associated with the disruption in China and disruption in supply chains, and what opportunities this might present for other developing countries. I feel like a bit of a muhu now for thinking along those lines. But this is, showing for different subsectors of manufacturing in South Africa, basically each and every subsector has had a decline in industrial production over this year. Strongest for motor vehicles, for example, down by almost 3/4 in the auto sector. We can just see the devastating effects on our manufacturing sector. And although, as I said, China is a bit of an unfair comparison, and manufacturing in China was affected, but we can see in many sectors actually being positive. Just in case it's not clear, in the case of South Africa, this is the zero line, so everything is above that. In China, this is the zero line over here. So most sectors showing real growth. I think I'll just skip this. I'm actually out of time. Sorry about that. So let me just really, this is my last slide. I'm not going to go through all of this in detail. I really just to highlight from this period, this experience, some of the implications for manufacturing and industrial policy. Maybe just to mention one or two highlights from here. I think it's drawn attention to the importance of state capabilities. I think we can see that the kinds of capabilities that are both important for industrial policy and are built up through the actual practice of industrial policy have also proved important in managing the pandemic, not only economically, but in terms of public health. I think it's drawn attention to the importance of productive capacity in manufacturing, of coordination between industrial policy and in particular macroeconomic policy, but all other policy domains as well. I think I'll just have to leave it there without going through all of these and hand over to the next speaker. Thank you.
Excellent, thanks Fiona. Incredibly rich, and hopefully we can return to a few of those points. Seeraj.
Thank you, Gillard. Thank you, Richard and Fiona, for very good inputs. I'd like to just start. Can everybody hear me okay?
Yes, thanks, Seeraj.
Good, thanks. Never sure with Zoom. So just to greet some of the people that I know in the that I see in the panel. It includes you and Sam from the CSID at WITS, my former colleagues, and the former Minister of Trade and Industry, Nimrod and Faisal and Rob. Hi. There are lots more, including Go, but I won't go into others. Just say glad to see all of you here. I just want to start with saying that, the one thing that's been good for me about UNCTAD's trade and development reports, but also the publications, and also publications from UNDESA, like the World Economic Prospects report and monthly briefings, is that it's played two roles for me. Maybe I should start with, take a step back as well. I see that you've put me down as coming from the Parliamentary Budget Office and also as the acting head. Usually in these kinds of talks, I like to present myself as independent. So I'm not presenting the views of the Parliamentary Budget Office here. What I'm saying is not that I'm going to say anything here that I haven't said in Parliament or to the Committees of Finance and Appropriations. And secondly, that it may be a bit of an overstatement to call me the head of the PBO. I'm acting for a short period, and my acting period ends at the end of the month. So I am currently a deputy director in the Parliamentary Budget Office, just so that we don't get confused and that people don't see me as misrepresenting myself. So just with the UN agencies like UNCTAD, like ESA, and also publications that have come out from the ILO, especially during the period when countries implemented fiscal consolidation, these have been really useful in the diagnosis and the solutions in the work that we present to the Finance and Appropriations Committees on the fiscal policy framework in the medium-term budget policy statement, and in response to budgets and other presentations by National Treasury and others. And it also helps when you can actually use the IMF and the UN agencies as proxies for yourself and National Treasury to say, well, you know, these are the contrasting views in the international community, people doing global analysis. And you know, as a country, we need to look at which works better for us. And so we've been pushing against fiscal consolidation for a long time and using arguments, showing the impacts for the good work that the IMF has done, people like Otis and others, but also drawing on the work that UNCTAD has done particularly. And also if you look at PBO publications and presentations since I joined in 2016, we don't only present projections about growth and other things from the IMF, we also include UNCTAD and ESA and other and UN agencies and also the ILO work on unemployment and what's happening globally. So in setting the scene globally and to get people to understand what's happening in South Africa, those have been really the work of the trade and development reports and the other publications, the occasional and the flagship publications, have been really useful. And I say that also set the framework that I agree with what's in the trade and development report. We've used it, and I don't really have an argument with it. I think what my comments will be, and I'll keep them short. I actually going to set my time on my phone while I'm speaking to you so that I don't go past my time. Is to sort of maybe focus in on some issues on South Africa, but related to what I see happening in the global debate. And the point that Richard made from the quote from one of the ministers of finance in Africa is that there are now two categories of countries: the developed countries and the developing countries, those with access to low interest rates or close to zero interest rates, and those that have higher rates. And the IMF and others are saying, you know, there are different solutions, and that those countries with higher interest rates should be moving towards fiscal consolidation faster. And there's a bit of a mixed message, because they're saying while the pandemic's still going and possibly growing, people need to do everything they can, and the country should take on debt, but they're going to get themselves into debt problems, and this is the international solutions to that, and they need to move towards fiscal consolidation as soon as possible. And also with things like capital controls, again, there's a mixed message where they're saying that it should be considered, but in discussions and also in the publications, they sort of discourage the use of those in developing countries. So what we're seeing in this kind of narrative that's developing is that the recoveries are going to be around infrastructure development. And in South Africa, and I think coming out of the kind of narrative that's developing, is that government plays this role of facilitating and leveraging private sector infrastructure investment and through PPPs and other things. And I'm glad that Sonia is going to be speaking more about that after me, so I won't have to go into that into detail. But what we're seeing is then in South Africa, what's happened is while saying that they're going to go for aggressive infrastructure development, we're seeing a reduction, very real reductions in government budgets in the expenditure, and saying that is to bring it under control. And I think we've been agreeing with the views of UNCTAD for a while, and it's been our own views that you actually have to look at the debt and GDP and look at increasing GDP. And what's happened in South Africa with the adoption of fiscal consolidation is that that has been a real drag on GDP growth. And one of the reasons that debt to GDP is higher is because of the adoption of fiscal consolidation from 2012-13 in South Africa in the post-crisis period. And so government in reducing its expenditure, and this is also expenditure on basic services and things, is reducing the role of the state in the economy and giving that role more to the private sector, and in areas where things like services infrastructure, where there shouldn't be a profit, where the motive should be developmental. I mean, in South Africa, there also needs to be a much broader development project with industrial policy and industrialization as part of that. But one of my concerns is that we're seeing that problem. And with that, besides leveraging infrastructure investment, the options they're offering for economic growth are all supply side oriented, and they link to structural reform, which are sort of increasing market friendliness, deregulation of labor markets, to put it more broadly, and to some extent maybe caricaturing it, but that's a lot of what I see in those kind of structural reforms, plus further deregulating exchange controls and capital flows into the country, yeah, and sort of so saying that in order to get growth going and growth going quickly, we should do those. But it's clear that from those kind of solutions, even if they were to lead to growth, wouldn't actually lead to growth quickly and deal with the kind of large aggregate demand problems that have been coming to South Africa, not only with COVID, but since the global financial crisis, and especially households. And within these kinds of solutions that are being offered, and Jonas touched on this to some extent, there isn't really a sense of understanding why the South African economy is in the situation that it finds itself in, understanding the history around the development and extractive economy under white supremacy type rule, where industrialization wasn't the industry wasn't developed that much, and in productive services, and it was around the extractive industries. And then the adoption by the apartheid government of neoliberal macro policies and other policies during the 1980s, and the beginning of the industrialization, particularly from the 80s. And then in the post-apartheid period, the South African new government maintaining those neoliberal macro policies, further deregulating financial markets and cross-border financial flows, and supporting the financialization and allowing large corporations to list offshore. And as Richard mentioned earlier, what you have is countries withdrawing their capital, their profits from developing countries, but maintaining their rent-seeking activities and intensifying their rent-seeking activities. And with us, South Africa becoming, yeah, I see 2 minutes, more dependent on extractive industries, while the financial sector is basically the key sector within the economy and driving a lot of what is happening. And so we're left with a very weak industrial sector and ability to create decent jobs. And so the crisis is a deep one. It's a deep one at that structural level, but there isn't an understanding of that. And I think the solutions that we see in this year's Trade and Development Report, with sort of reversing financialization, having industrial policies getting a larger role for development finance, and the way in which fiscal policy should be driven, is very much in line with my own thinking around that. So I think I've got about 30 seconds left. So maybe I should stop there, and any other issues I'll bring it up. Thank you.
Awesome, thanks very much. Just to note, Richard, there are some questions which I've copied back into the chat, so have a look at them in the interim too. But Sonia, over to you, please.
Thanks, Chair. Thank you, Richard, for your interesting and comprehensive presentation. And thank you to the organizers for inviting me to be a respondent, along with esteemed fellow panelists, to respond to this very important and timely report. I'll try and be short I don't know how successful I'll be. Sorry about that. I thought it would be best to speak a little bit about South Africa's proposed infrastructure-led recovery plan, which Seeraj has mentioned, because I think it's important to understand the implications of this plan as we transition from relief to recovery. So I'll touch a little bit on what is being proposed and offer some reflections on potential challenges, and what this could mean for South Africa going forward. And so as Seeraj mentioned, alongside kind of fiscal consolidation measures and structural reforms over the next 5 years, there is a concerted effort to kind of crowd in new private investment, particularly in infrastructure. So essentially the centerpiece of the proposed recovery plan is an infrastructure-led model that prioritizes de-risking large-scale infrastructure projects through a number of mechanisms like blended finance and public-private partnerships, or PPPs. And de-risking essentially means that in order to attract private investment, government are offering to shoulder more risk on behalf of the private sector. And I think it's important to note that the use of great infrastructure investment as a growth strategy is certainly not new. The National Development Plan, which was tabled, I think, in 2011, includes an ambitious goal of reaching a 30% of GDP investment in infrastructure by 2030. And so far, I think we're currently only at 13%. And I think that says a lot about public investment in infrastructure, which has steadily declined over the past decade or so. And what is different about the current drive for infrastructure investments compared to previous ones is the current focus on leveraging private sector investments, international and local, through blended finance. And this has been, I'll explain what blended finance is in a moment, but this has been proposed to achieve through the creation of an infrastructure fund. And the fund was formally set up earlier this year and is a collaboration between National Treasury and DBSA and the Department of Public Works and Infrastructure. And so far the government have committed, I think, about 100 billion to the fund for the next 10 years. In the hopes that this will kind of catalyze around 1 trillion in private investments over the same period. Although reporting on this value has changed quite a bit since the initial announcement. So we'll keep it to, I think, between 800 billion to 1 trillion in private investments. So what is on offer? Well, the infrastructure fund offers de-risking mechanisms called blended financing, and blended finance basically describes a situation in which public finance is channeled into bankable infrastructure projects for the sole purpose really of altering the risk return profiles of the investments, which make it in favor of the private sector. And there are a number of ways the government can do this. It includes mechanisms such as government funded subsidies, interest rate grants, capital grants, interest rate risk guarantees, to name a few. And it also includes other more complex mechanisms, which include converting infrastructure into an asset class to be traded on the market, not unlike the mortgage-backed securities that was kind of the hallmark of the financial crisis in 2008, 2009. There's also a kind of doubling down on efforts to increase investments in PPPs. And I think it's important to note that despite government's prior efforts at promoting PPPs, they have attracted less than expected private investment. Only about 2% of total infrastructure investment so far is from PPP since the first project in, I think, late 90s. And there are a number of reasons for this, I think, that bears reconsideration as we kind of marshal more limited state resources into de-risked investments of this kind. And I'm going to highlight 3 reasons. I'll try and be quick, but I think they kind of reflect broader issues with a kind of private sector infrastructure-led approach of this kind. The one, I think we need to think about what the real implications of de-risking infrastructure will be, who will ultimately carry or absorb the risks on behalf of the private sectors. And already IFIs like the World Bank, for example, who ironically are also proponents of private sector kind of infrastructure measures have shown that PPPs generally shift a number of infrastructure risks to the fiscus, which ultimately leads to more costs to the taxpayers. PPPs, for example, are usually favored by governments because they are considered off-book transactions where the liabilities are kind of only realized in the event that the project fails. And when the project fails, obviously the government is contractually bound to pay this. And it's often the case that by nature of large-scale infrastructure projects, which is what the fund is actively promoting, these liabilities will balloon. Already, the latest MCBPS tabled last month estimates that expected contingent liabilities will reach an estimated or an unprecedented 1 trillion by 2022, 2023. And this will no doubt pose huge financial risks to the fiscus. In the case of blended finance, the risk posed to the government is a lot more direct because the government is essentially accepting maximum risk on behalf of the private sector, which poses its own set of problems around how much risk is enough to incentivize private capital, and how much or at what level will this risk create a moral hazard problem in which private investors have no incentive to limit their costs and associated risks because they know that the government will kind of absorb it for them. And my second point, which is linked to the possible risks, is kind of the proposed developmental impacts. The fund has a clear developmental objective and kind of prioritizes bankable projects, which implies projects that have a very clear business case. However, the focus on bankability is often at odds with the real infrastructure needs, most of which we know are in underdeveloped areas, characterized by high unemployment, informal settlements, rural areas, and often not commercially attractive areas. So marrying these two, private investors who are primarily concerned with recovering upfront investment costs through user fees, while the state is concerned with achieving developmental objectives, will have definitely misaligned incentives. And what does this mean for kind of basic service delivery in areas with high unemployment, for example? We've also noticed that private financing for infrastructure has also been heavily concentrated in certain sectors. Energy and information and communication sectors, for example, receive, I think, over 30% of total international funding flows between 2008 and 2017. And I think this is a World Bank estimate. At the same time, water and sanitation only received 7% of total private financing in that same 10-year period. And of course, in South Africa, given the large infrastructure gaps, we welcome more investments in energy and communications. However, if this crowds out other investments in less commercially viable sectors, then the question then becomes, who will invest in more social infrastructure like education, particularly in the context of austerity, where these sectors are kind of usually the first to receive budget cuts. And the third point, I think, it's important to think, and I'll just join these two things, potential environmental impacts of large-scale kind of mega projects, as well as public accountability mechanisms. In fact, last year's UNCTAD report highlighted that PPPs in infrastructure have tended to kind of undermine transparency and public accountability as they frequently appear as off-book transactions, as I mentioned earlier. And so there's no duty to kind of divulge information about off-book transactions, but also, the bigger, more complex the project, the more difficult it becomes to be, transparent. And so the preference for an increase in funding for mega projects, I think, crowds out smaller, more inclusive and environmentally stable, sustainable ones. Large-scale projects are notoriously environmentally costly, and already a proposed project under the Infrastructure Fund has received backlash from environmental groups relating to a water augmentation project in Limpopo. I know I have a little time left, but I want to end by saying that the private sector, I'm not disparaging the private sector in any way. I think it has a very important role to play in our economic recovery, as outlined in the report. I think we need to think carefully about balancing the role of the state and the private sector in achieving a just recovery. Infrastructure is important, but it's not an end in itself. It's important that we think about how we use it and who has access to it. Infrastructure must be accessible, particularly to areas that have historically received severe underinvestment. I think we'll need to be realistic about the expectations that we have placed on the role of infrastructure in leading to economic growth, which is still contested in the literature. We will also need to think a little bit more about the expectations we have placed on the private sector, who at the end of the day are beholden to shareholders and not citizens. And lastly, I think we need to demand that the government be explicit and honest about who will benefit the most from the fund. I think a lot of the language currently used around the fund is couched in very simplistic narratives of win-win relationships, which I think kind of obscures the complexities of aligning incentives from a range of involved stakeholders. I'll stop there.
Awesome, thanks, Sonia. That's really interesting, and also the subject of a report which Sonia's working on with the Friedrich Ebert Stiftung, which will be available later this year. We're pretty much out of time, so I'm just gonna mainly, I've got, Richard, you've seen that list, so I'm hoping you're gonna be able to kind of weave those in. I'm gonna add to that perhaps a overarching one, which in what Fiona and Seeraj have both said is that there's been there's been a lack of taking account of what the crises in South Africa were before this in our recovery, and that's borne out in what Sonia said, in terms of having shaped what the center of our recovery plan is, and just a reflection sort of on that. Fiona, you've already have dodged the controversial question in the chat function, which is understandable. But what I want to ask you is about the intersections of industrial policy and austerity. You've mentioned both of them, that austerity framework could undermine where we're at. You've shown that there's been a fall in industrial production, and you note the importance of reviving that. But often in South African discourse, what we see is that people are saying, okay, yes, let's do the industrial policy, but at the same time, let's implement austerity, right? And those are, do you see those as possible to happen at the same time, or are they undermining of each other? For anyone, just to say, and then I'll for anyone further interested in part of UNCTAD's views on this private financing questions, I would highly recommend last year's TDR also, which engaged quite substantially. So Richard, then if Seeraj and Sonia want to add anything, and then Fiona, the last word to yourself, and we'll end there.
Yeah, Gilad, thanks. Well, not only last year's TDR, actually the 2018 TDR looked at this in particular in the context of infrastructure. Diana worked on that chapter, in fact, and I mean, the point, and I agree with Sonia on a lot of what she said. You know, I mean, it's not just an infrastructure thing. It's the whole maximizing finance strategy that the World Bank has adopted to push for behind the SDGs, for example. I mean, it's not so. I mean, that idea that somehow private finance, if you can just incentivize and de-risk it through public money, will somehow deliver public goods, is the dominant narrative, I think, coming out of Washington. And we've tried to debunk that narrative I mean, certainly in last year's Trade and Development Report with explicit attention to the climate challenge. But it's a more general I mean, it's a much more general. I think Daniel Gabor calls it the shift from the Washington consensus to the Wall Street consensus. And I'm sorry to say, it's not only the IMF that's pushing that. Large parts of the UN system have kind of fallen for that too. So I think that is a dominant ideology that needs to be constantly challenged, because, as Sonia said, the evidence on public-private partnerships delivering, let alone delivering more cheaply, is almost non-existent. The UN poverty rapporteur Paul Alston, who retired this year, came out very strongly against a lot of this stuff. So I think, I mean, I agree with a lot of what she said. I mean, I think you know, what connects a lot of what we have to say from a policy point of view, and I think Seeraj and Fiona made these points clear. I think it was clear from their presentation, is the need for an integrated strategy. You can't do macro finance, trade, industrial policy in silos. Or if you try and do it, the chances of you creating inconsistencies between policy positions is almost guaranteed, I think. And so that need for an integrated perspective, I mean, we've always argued that, you know, the successful developmental states of this world, and obviously particularly in East Asia, do seem to have an ability to forge that kind of more integrated perspective. And so, you know, what institutional changes are required for that, I think, you know, has to be up front and center in any sort of discussion. And that's why we think development banks are very important, not just because we think that they provide a more stable source of long-term financing, but they can be the focus for a more integrated policy perspective too. So I think that emphasis on the need for an integrated policy perspective is incredibly important. And in answer to your question, you can't do the kind of policies that you can't create an inclusive, sustainable, resilient future on the back of austerity. I think the evidence for that, we give some more of it in this year's report, I think is unquestionable. You know, the idea of expansionary austerity is a complete myth, essentially. So I think, I mean, but I think that really, a more positive agenda is how you think about these challenges from an integrated policy perspective and the kinds of developmental institutions that are required to backstop that integrated perspective, I think is where the discussion really needs to go. Just in response to a couple of the points that are made in the chat very quickly. I mean, the debt issue, I mean, ultimately we're going to have to cancel debt in response. Someone asked that question. You know, if you look at the debt service sustainability initiative of the G20/IMF, I mean, it's pitiful. You're talking about 5 billion, and it's not even, that isn't even cancellation, it's simply suspension. You're talking about something in the order of $5 billion between the 73 of the world's poorest and most vulnerable countries. I mean, it's pitiful. And given the size of the size of the financial hole that is going to hit the developing countries is going to face, we think cancellation is inevitable. The question is, how is it going to take? The issue with cancellation is how do you cancel, not whether you're going to cancel. Cancellation is inevitable in one way or another. So the issue is, how can you do that in a way that is not disruptive and destructive of a growth path that is sustainable? I think that's why we think you need, again, an institutional response. The IMF can't do this. The IMF is a creditor itself, and you need an independent, what we would call a global debt authority, to be able to implement the kind of restructuring and cancellation strategies that we need. And we go into that a little bit in the report, and we'll have something more to say on that in the G20 context in the coming weeks. Do we think that are we worried that these big packages might peter out quickly? I think the answer is we are worried about that. That's why we came up with a lost decade scenario in which, I mean, the point about the packages is, well, 2 points. One, it's very difficult to actually give a real estimate of these packages. The figures that we give in the report are what the government says it's going to do in the different places. That doesn't mean that's what's going to happen. We've already seen in the particular case of India, for example, that there is a tendency to exaggerate or to front load things that you were already planned to put as part of a response to COVID-19. And so it's quite difficult to make the estimates of the size of these packages in the first place. Second place, they're not really recovery strategies. They are relief. In most cases, they're relief strategies. And the point is that there will be a lot of pressure, given the scale of those packages, to scale them back when what you need is more of the same, but directed towards recovery rather than relief as we come out of lockdown and some sort of control is placed on COVID, on the health side of the crisis. So, I mean, we are really worried that there will be, and it's not just ideological neoliberalism. I mean, there are vested financial and interests that will be backing a return to austerity. And it's not just an ideological fight, I think, that we're talking about here. We're talking about very powerful economic and political interests that will be pushing in that direction. And that's where the fight will be, as much as in the technicalities of economic adjustment. So, I mean, we are tremendously worried about that. Cooperation, I mean, I'll leave it on this point. The question of international cooperation, we don't try and sell this as charity. That is, the North has a moral responsibility to support the South, although we think that's the case. We think it's in the economic interests of the North as well to support developing countries in terms of providing potential outlets for investment, for markets, etc. This was the logic, if you like, of the Marshall Plan. You know, a lot of the ideas behind the Marshall Plan were not that they wanted to stop communism arising in Western Europe, although they wanted to do that, but they also understood that a vibrant Europe was in the economic interests of the United States too. And I think looking at cooperation, at least in terms of why the North would itself benefit from committing the kind of resource it's been promising developing countries for decades. It's never hit the 0.7% ODA target, for example, whereas the Marshall Plan channeled 1% of US GDP to Europe for 5 years to rebuild, to start the process of rebuilding. And it worked, essentially. And so you know, we do think there is a certain moral responsibility of the North, but there's an economic logic behind the advanced economies providing the kind of resources to get developing countries through this and growing again. I think that was more or less it.
Yeah, no, that was a fantastic note on which to end. Fiona, I know you have a call in 2 minutes time, so I'm going to offer you an opportunity now, and then I will close, unless Seeraj and Sonia want to add anything.
I mean, I can stay a bit longer and be late for my other things, so let them go ahead.
Anything? Yeah.
No, I don't have a really big point. I think Richard just encapsulated well. I think it's really important that we rally behind alternatives. And I think, you know, to avoid this 10-year, the next 10 years being the last decade. So yeah, we really need to, as a country, think deeply about the trajectory we are currently on. So that's my final contribution.
Awesome, thank you, Sonia.
Am I? I'm not on mute. You can hear me, right? The point I want to talk about. Can you hear me, Gilad? Hello.
I can, yes,
okay.
But you only have a minute.
It's just the use of QE by developing countries, and QE not only to sort of unblock the financial systems, but to support government spending, especially dealing with COVID. Sorry, I've got the fog in my throat. And yeah, I mean, we're not talking about modern monetary theory and the state can spend as much as it wants to and on anything. It's, I mean, if you look at the latest financial stability report, like the Reserve Bank's QE over the last 5-6 months has been less than 0.5% of GDP. And there's room for them to do much more besides, and they could also further drop interest rates if they weren't so scared about further portfolio flows. And I think part of the discussion that we need to have as well is to look at what other sources of finance are available until the discussion about debt and debt relief and whether they're going to be real haircuts or whether it's just postponing debt payments happen. And this should be more broad than that. And I think the space is open now for that. The Financial Times, The Economist, those kind of publications are putting out saying, you know, that we're emerging markets, we should accept that they will use kind of measures. So that's on the one side. The other side is, you know, capital controls and also managing balance of payments, especially the current account. And in South Africa, the current account is largely financial transfers, which overwhelm the trade balance. And in fact, the trade balance has been positive over the last few years, but payments of dividends abroad, etc., and those are linked to hot money inflows. You know, the profit repatriations, the dividend flows outside, it creates a larger negative current account. And so the need to actually link the discussion about exchange controls, capital controls, and your international financial relations, especially on the current account, needs to come to the fore, I think, this discussion. And I don't know how true that is in other countries, but I've been following it in South Africa. Thanks, Gila.
Excellent. And I think that speaks well to this issue of integration in policy. Fiona.
Yeah, just a very quick reply to the question that you posed, Gillard, which I think was, if I understood correctly, like, is there a connection between austerity and industrial policy or industrialization? I think, yeah, the answer is obviously yes. I've been harping on that for the last 20 to 25 years. So let me just very briefly mention, I think, what some of the channels of that relationship can be. I mean, one is that austerity obviously dampens growth and reduces domestic demand for manufacturers. The kind of the fiscal channel through which austere fiscal policy means less funds available for industrial policy, so less effective, and perhaps at least as importantly, means less funds available for other things that also matter for industrialization and structural change, for skills development, for infrastructure. And it's energy infrastructure that's needed, it's transport infrastructure, it's ports for exports, and yeah, all of the myriad things which are needed for successful industrialization and structural change. On the monetary side, obviously, high interest rates, uncompetitive exchange rate, poor or weak or inappropriate regulation of the financial sector and of capital flows, all of these things would negatively affect industrial policy, industrialization, and structural change. So I think, for me, it's just a no-brainer that, you can have the best industrial policy in the world, but with wrong macro policies, kind of, I don't want to say wasting time, but it really undermines any industrial policy initiatives. So whilst there's so many areas that need to be coordinated with industrial policy, skills policy, innovation and technology policy, I mean, we could go on and on, but for me, like, the number one is always macro policy.
Awesome, thanks, Fiona. And I think what this highlights is the need for we hear the rhetoric of a recovery plan in South Africa, but what we really have is different pieces of the state pulling in different ways, which actually creates a incoherence. And what I think the UNCTAD report offers is to say, actually, there are coherent and integrated strategies. And on a global level, the report really offers us a vision of such a coherent, a integrated, and a logical path for a recovery which prioritizes not only economies, but the individuals and communities which make up those. I've gone a little bit over because it is rare to have a constellation of these speakers between this platform, Facebook, and elsewhere. We've had over 100 people here, including many leaders in their field, and we're sure that there'll be significant uptake of this video once it is circulated. So to our UNCTAD colleagues, to our colleagues at Daily Maverick, and all of our panelists, thanks very much.
Thanks a lot, Gila. Thanks. Bye-bye.
Thank you.
And
Thank
we're